Hello, and welcome to CUNA's July Economic Update. I'm Samira Salem, CUNA's Senior Policy Analyst. Today I'm going to focus on our July Economic and Credit Union forecast. So the U.S. economy officially entered a recession in February due to COVID-19. And with that, we ended the longest economic expansion since the 1850s. Most economists expected that the coronavirus recession would be incredibly sharp and very short-lived. We thought that we'd see the virus recede in the summer. That would allow for a rebound in growth, and then we'd get the second wave of the virus in the fall, and economic activity would slow again. Instead, the economic recovery that started as states opened up in May and others in early June is faltering as we're seeing a surge of COVID-19 cases that's leading to around 70% of states reversing course on the reopening. This is certainly slowing economic activity and increasing the likelihood of a protracted recession. This is all happening just as the fiscal stimulus from the CARES Act, which is really aimed at helping tens of millions of unemployed Americans, as well as businesses, is about to expire. So the President and Congress have been signaling that they're willing to provide a second, smaller, and certainly more targeted stimulus payment and smaller dollar unemployment benefits. We'd like to see a generous stimulus package that responds to the scale of unemployment, lack of jobs, and challenging economic climate that we're living through. As states begin to open up, we saw economic growth pick up, but the pace of growth is now slowing because of that unprecedented surge in COVID-19 cases that we just saw on the previous slide. We expect economic growth to remain muted in the fall and winter months as we adjust to this new normal of mask wearing, social distancing, as we get more testing and tracing in place. And overall, we forecast a 5.3% fall in real GDP in 2020. And this will be followed by growth of 4% in 2021. If you take those 2 years combined, this translates into negative growth for the 2020-2021 period. This recession has brought a lot of firsts, including a deep and rapid dislocation in the labor market. This was concentrated in March and April. Unemployment started off at a really healthy 3.6% in January, and it jumped more than fourfold between January and April. I say more than fourfold because there have been some major issues with measuring unemployment. You'll notice that starting in April, we've got the blue bar and the gray bar. The blue bar representing the number that BLS puts out officially, and the gray bar is the adjusted number. And what happened is that BLS, there was some misclassification of folks that were out of work due to COVID, so they weren't counted in the sort of blue bar, the official number. So they're represented in that gray bar. Over time, the level of misclassification has decreased significantly, so you'll see the difference between the gray and the blue bar they're getting closer. We expect that to no longer be a problem over the next month or so. But we will continue to report it as long as there is an issue and BLS is identifying that. So overall, though, we've seen a decreasing trend in U.S. unemployment over the last 2 months. But this is really in the context of levels of unemployment that are higher than the high reached during the Great Recession, which was 10%. And while there's some talk about whether unemployment insurance benefits are incentivizing folks to stay at home, what we know is there simply aren't enough jobs to absorb the millions and millions of people that are out of work. In addition, California, Florida, Texas, and Arizona, which employ together a staggering 30% of the U.S. workforce, are experiencing an unprecedented increase in COVID-19 cases. So we expect there to be further unemployment and slowdown in those states. So we expect the decreasing trend in unemployment to slow and unemployment to register 10% by the end of 2020 and 8% by the end of 2021. While unemployment rates have skyrocketed for all workers, as we just saw, the unemployment rate is highest for Black and Hispanic Latinx workers. That's because primarily they are more likely to work in the service industry and low-wage jobs, and these are the jobs that have taken the biggest hit when it comes to the pandemic. Job loss is hard for everyone, of course, but the brunt of the burden is really falling on those who are least able to bear it, and I should include women in this. Some are calling this a she session because the lack of childcare and the fact that women still carry a lot of the burden when it comes to childcare. So it's having quite a disproportionate effect on women, of people of color, and recovering from this job loss tends to take longer for these groups. And so they'll spend more time looking for jobs, and they will generally find jobs that will pay less than the ones they've left. We don't expect the Federal Reserve to increase the Fed funds rate by the end of 2021. In fact, we expect the effective Fed funds rate will probably hover around 0.10% for the remainder of this year and into 2021. And here's yet another historic moment. Yesterday, July 16, the 30-year mortgage rate hit 2.98%. This is the lowest rate ever. So the housing market seems to be humming along. This is obviously helped by this historically low interest rates, despite the fact that there is tight inventory, relatively high home prices. But the lower mortgage rates have particularly helped boost mortgages and refis, and we'll see that in a moment. Our complete economic and credit union forecast is available on CUNA's website at www.cuna.org/economics. So you can take a look at that there. And I'm going to move on to taking a look at credit union operations. We'll start with loan and savings growth. So first quarter data shows that savings growth was strong, growing at 8.1%. CUNA's monthly credit union estimates from May show exceptionally fast growth in credit union savings balances. Year to date, credit union deposits grew 12%. So we're on track for incredibly strong growth for the year. Our estimate is that savings will come in at 17% for 2020 and go back down to a still very healthy 8% in 2021. The rapid savings growth this year is for the most part due to government stimulus checks. We also know that typically during recessions, consumers like to save, or they tend to save for a rainy day, and they'll pull back on spending and on most borrowing as well. When it comes to loan growth, our first quarter results show that year-over-year loan growth came in at just under 7%. In this low interest rate environment, people are buying homes, so mortgages as well as refis are booming. Looking at CUNA's monthly credit union estimates for May, first mortgages showed an incredible 12.9% growth. Apart from mortgages and refis, used autos were really the only other loan category that showed some growth in the latest monthly credit union estimate. Turning to ROA, the combination of these ultra low market interest rates and a shift to fast growth in very low yielding investments means that we will see a decline in net interest income. There's more pressure on ROA from rising provisions for loan losses, as well as decreasing interchange income. In addition, we know from anecdotal evidence that many credit unions are waiving fees, they're offering emergency loans and more. And this is all certainly with significantly lower interest rates, and all this will result in a decrease in earnings. All that said, earnings will be supported by or at least slightly by the strong mortgage lending and strong growth in refis that we just discussed. So our forecast for ROA for 2020 has it coming in at 35 basis points. This is still well above the Great Recession low of 18 basis points, which we hit in 2009. In 2021, earnings are going to fall even further to 10 basis points. This will happen as losses mount. Interest rate margins are going to remain extremely tight, and this is going to and limiting returns on loan portfolios and investments. There's no doubt that we're seeing unprecedented challenges at this moment, and in this time, it's really good for us to reflect on how strong credit union membership has been, not only in the recent past, but also, in the recovery from the Great Recession. Since 2016, membership growth has been growing at an incredible 6 to 7 times the rate of population growth. And again, credit unions did really well in the recovery from the Great Recession as more and more consumers noticed credit unions and showed that they valued what we do by joining. Membership growth isn't surprising. Credit unions have a well-deserved reputation among consumers of treating their customers fairly, providing great customer service, and acting in their customers' best interest. This will serve us well as we navigate these challenging times. Again, for a complete economic and credit union forecast, check out CUNA's website at www.cuna.org/economics. Thank you. Be well and stay healthy.